Good afternoon and good morning to everyone, and welcome to our webinar on the active adult market. This sector has been getting a lot of attention in the last couple of years, and understandably so, because there's a lot of potential for growth in the next decade. There's a lot of reasons for that. There's lower staffing needs, higher rents than typical multifamily, high operating margins, attractive demographics, limited competition for now, just to name a few. And the sector is still relatively new, meaning that the definition for exactly what it is remains a bit murky. So we're going to be hopefully helping to define the sector a little bit more during this conversation. But also in such an emerging sector, investors and operators will keep experimenting, mistakes will be made, and some will do really well and become a model for the rest of the sector. So that'll be part of the conversation as well. And we only have an hour today, and we have a great panel of experienced operators, investors, developers, and deal makers who will be doing most of the talking. And thank God for that. And I'll introduce them in just a second, but just want to bring up a few administrative items before we begin. If you experience any technical difficulties with today's webinar, please contact Levin Associates Customer Service at 203-846-6800 or email us at info@levinassociates.com. At any point in the webinar, listeners can enter questions for the panelists in the Q&A box in the Zoom window, and we'll do our best to address them in the hour. The slides for today's webinar can be found in the chat box here, but feel free to reach out to Levin's customer service if you can't download them. The slides include our proprietary valuation statistics, which are derived from public and private sources, and from the properties that have sold in the last 4 years. We've spent the last couple of months putting these statistics together and are very excited to be releasing them. We'll be adding further context around the data in the webinar today. And you can also find the statistics plus about 50 others in the just released 28th edition of the Senior Care Acquisition Report, which is available to Levin Pro LTC and LTC News subscribers. We'll soon also have an analytic up on our Levin Pro LTC platform where users can filter pricing data based on property age, quality, and other metrics. So look out for that, and feel free to email info@Levin Associates to set up a demo. Lots of exciting new developments here. And without further ado, let's get to our panel. So first we have Mark Myers, he's the managing director at Walker & Dunlop. Mark has more than 30 years of real estate experience, having previously worked at Marcus & Millichap, where he and his team closed over $8 billion in seniors housing transactions. More recently, and very applicable to today, Mark led the sale of 25 active adult assets for Calamar, which sold to Welltower for $502 million in May of 2022. Very happy to have you on. Welcome, Mark.
Good to be here.
And next we have Richard Hutchinson, who's the co-founder and CEO of Discovery Senior Living and its family of companies. Also, more recently, Richard became the CEO of the newly combined company of Discovery and Integral Senior Living, which is now the 5th largest seniors housing operator in the country. And during his almost 30-year career, he's negotiated and closed more than $5 billion in equity and debt transactions, and is also a big advocate and provider of experiential living, which active adult can do so well at. So excited to have you on and have your perspectives. Thanks, Richard.
Thanks, man.
And finally, we have Mitch Brown, who formed his own consulting firm after serving as senior managing director for Greystar's active adult platform. And he was previously the chief development officer for Kisco Senior Living. Mitch brings more than 25 years of experience to the table and can talk to all facets of the active adult investment and operating world. Thanks for joining the panel, Mitch. Welcome.
Thanks. Happy to be here.
So it probably makes sense to start a conversation on the active adult market by defining the sector first. And I'll just start with the definition that was provided by Nick late last year. So according to Nick, active adult rental properties serve older Americans who wish to live in a multifamily setting with other residents who generally are more independent and active than residents in today's senior housing offerings. As a commercial real estate property type, active adult rental properties serve residents who are younger and have lower acuity needs than the current residents in seniors housing independent living. They have no required healthcare licensure, less operational intensity than seniors housing, potential rent premium compared to conventional multifamily properties, and typically longer length of stay than that of senior housing residents or younger multifamily residents. And we would also add, this is separate from the Nick definition, that while most active adult communities are apartment buildings, cottage style communities would count as well, as long as the cottages are only available for rent. So, Mitch, just briefly, is there anything you would add to the NIC definition here?
No, I think Nick did a good job of that. They actually have reached out to a number of us who are actively doing active adult to get input into the definition, and I think it's solid. And I think your addition of the rental cottages is or casitas, we're going to call villas, is very appropriate. It's one little tweak I kind of had hoped they would make, and you made, and kudos.
Oh, music to my ears, Mitch. And then Richard, can you just tell me why active adult is booming right now?
Sure. There's a lot of reasons. Of course, I'm going to go with the macro one, Ben, because I think it's most germane. I think it's booming because the opportunities are booming in that space. Look, we've been in this space for quite a while, not only the active adult space, but seniors housing. And we used to all take care of 70-something-year-olds in our independent living communities. During the Great Recession, that really changed, and we voided that space. And so as you're seeing the demographics come forward, of course, you're seeing that space not having been served very well over the last decade and a half or so, almost 2 decades. And so it's opportunity. So it makes a ton of sense. Yes, more contemporarily, there's labor differences that are now factoring into this and making it more attractive for sure. I don't think that's the going in thesis of most people, that they only have to employ 5, 6, 7 people. So that's why I'm doing active adult. I believe it's because of the opportunities in that space, and clearly the macro environment is forcing us to look at that space. And it's, when you look into it and peer into it, clearly the opportunity is there, and we're pretty bullish on it.
Yeah, I don't think you'd be alone there. And Mark, would you say that active adult is kind of closer to multifamily or seniors housing as a product type?
Well, I think it's definitely a combination. I'd say it's probably closer to multifamily, but it is definitely a tweener, as we'd say. I mean, it's, the average age is 70 to 72 years old, typically female, a lot of times a widow, although not always. About 30% of the people are still working. The rents are about 30% higher than multifamily, but they're about half of independent living rents. So I'd say it's closer to luxury multifamily than it is independent or assisted living, but still has many of the components of senior living. To Richard and Mitch's points, it's a great subset of senior housing and multifamily both. It's a nuance of it that provides another product type that's needed.
Mm-hmm. And just quickly, what kind of staffing differences do you see in active adult versus typical multifamily?
Well, I think it's around the same. You'd have a marketing or activities person that you probably wouldn't have in most multifamily communities, certainly. And once in a while, you'll have a housekeeping person for the common area spaces. You may have a few more people as you're leasing up. But I think in general, to Richard's point, I think the staffing is, closer to multifamily staffing than it is independent living staffing.
Mm-hmm. And then you mentioned that rents are typically around 30% higher than multifamily. Can you tell me why you think residents are willing to spend 30% more to basically just live in an apartment? What's the difference?
Sure. I think it's more about psychographics than demographics. And by that, we mean, the resident that's moving into active adult wants to be there because their friends are there. They're going to play bridge and do different things with them, and feel secure and safe. If they go on vacation and come back, they'll have their unit there. They're not in a house by themselves, and so there's more security in it. So that's why they want to live there. Mm-hmm. And they're willing to pay a premium for that, and they're saving the money that they don't need at such a young age, and given their health conditions being excellent, they don't need the housekeeping and laundry services that may be available in a typical retirement community, and they don't need the food service. They can either cook for themselves, or, as most Americans, go out to eat 3 or 4 days a week and go out with their friends and still see their kids and their grandkids. So these are very active people, as the definition describes. And so, I would say I'd say that's why they're paying a premium for it, though.
And then Richard, you're involved in kind of almost the entire seniors housing continuum. So what can you tell me what do you think active adult can do better than the other seniors housing sectors, and any lessons that perhaps the seniors housing sectors can learn from active adult?
Yeah, it's a good question. I'm not sure I know the answer to that, but I will tell you, to back up. First of all, it took me a long time to get my head around active adult as the name here. As you know, we talk about experiential living instead of active adult, and just a little different flavor. But what Mark was saying kind of prompted me to want to say something about the psychographics piece of it and the premium in which active adult gets to multifamily. Really, from our standpoint, we did a lot of research because we have done a fair amount of traditional active adult. And then in our new iteration of the Choreograph brand, where it's experiential living, slightly higher staffing level, but it had a lot to do with the psychographics in our research in the customer. And I realize I'm completely off your question. And so I'm going to be a politician and answer the question that I want to answer, not the one you actually asked. So people need to get used to it this year. That's kind of a lot. But at the end of the day, what we had found is the consumer, which we base all of our decisions on, they had very different desires than our seniors housing population. And I'll tell you, our residents in seniors housing, the one thing we glean from the seniors housing side of our business is the nuance of taking care of older folks. But the consumer itself in the active adult experiential living space, there's probably a demarcation of about 30% of their desires on what they experience every day, how they experience it, beyond the healthcare and everything else. This is a very mobile-oriented consumer. And so Mark had prompted me because he had said something about if they go on vacation and everything. That's actually part of our thesis, that these folks are going to want to be very mobile. They're going to want a lifestyle that allows them to experience not only what's going on in the seniors housing, the active adult community, but surrounding it, and then more globally, they want to move. They don't want to just stay put forever. And so when you think about that and you think about it relative to seniors housing, very different profile. In seniors housing, it is concentrating more locally, as far as their life. And these folks, what we have found, it's actually the opposite. There's a pattern of life, and where they are in their 70s now, we used to define as 60s, post-retirement, where you're in your discoverist phase. So you're wandering around, you're rediscovering your life and your purpose post-retirement. Well, a lot of these folks now in their 70s are doing the same thing. They're trying to create a new purpose in life and discover what it means to have left a lot of those things behind. So it's a very different customer profile than traditional seniors housing. So we decided to not drink our own Kool-Aid and do a ton of customer research because what we're finding is seniors housing customers are here, active adult / experiential living here. And yes, in the middle, they might meet a little bit, but be careful if you're a seniors housing person to just simply say, hey, they're going to be the pre-seniors housing resident, and they're going to act a lot like seniors housing on some level of linear progression. We're not seeing that at all.
Yeah, Ben, I'd like to layer onto that. That's absolutely right. What we learned over, what is it now, almost 4 dozen ground up projects that I've been involved in between Carlisle and Greystar and a few other developers is what Richard's saying is the segmentation piece is real, and it is driven by psychographics. Yeah, and sort of the early learnings from the multifamily side was they use psychographics, but not to the extent that we do in traditional senior housing. And using those tools and really understanding the customer at a visceral level. There is a bifurcation in this more upmarket, the discoverist, the original Overture thesis. There's a very different customer than, say, the people at the more middle market product, like some of the stuff that Mark's been involved in recently, where, you know, they're looking for shelter, they're looking for safety, they're staying in their traditional neighborhoods where they've grown up and their children have grown up and they're sort of staying put. And then there's this very mobile group, which tends to be a little bit more of an upmarket segment that will move to where their new grandchildren are, or move to someplace they've always wanted to live, possibly to their college town, who knows? But I think understanding those differences, and I think the way Richard's tooling his new vision is very much in line with what we're seeing in a lot of the active adult that's been built so far. And so if you're gonna do it, if you're gonna get into it from the senior housing side, to Richard's point, be careful. You know, understand, you know, just like in traditional senior housing, figure out what you're really good at and what you want to do and execute that. Don't, you know, I think trying to do too many different things can be a challenge. So, you know, you see some of the real successful companies, the Sparrow, Clover, you know, Greystar and others. They definitely have developed a specific brand or a couple of brands, and they've executed those brands very well consistently, and have learned from each one in the next one. And you can watch the evolution of these companies getting better and better and better at meeting the needs that Richard describes. And it's cool. I mean, we're in the first or second inning here, and it reminds me a lot of the assisted living in the go-go days of the late 90s. It has a lot of that same feeling where we're all sort of discovering this as we go.
And I think it's exciting because I think I have the statistic correct. The Wall Street Journal, I think, said that baby boomers have about $3 trillion of net worth. So, you know, we need it all. We need the affordable, probably more of the moderate priced active adult than the super high end, but you need it all because there's certain seniors that, you know, for whom the price is no object, you know, I just want something. I just want what I want, and I'll pay for it. And I'm only going to be here 4 months of the year, 6 months of the year anyway, and I'm going to be somewhere else. So you need it all. We don't just want one product, right?
Well, that you guys touched on a question I was going to ask later, but now seems like a good time. Does the current kind of, I don't want to call it mania because it's not out of control at all, but all the attention that's directed at active adult right now and a lot of optimism, how does it compare to the assisted living boom of the 90s? And then eventual crash in the early 2000s.
Well, I think it's more choice driven than assisted living by far, of course. But I think, and I think we could be susceptible to the same components that caused the crash in the assisted living space if we just build too much of it. You know, I think Wall Street got a hold of the assisted living concept, and some of these AL companies, I can think of one in particular, that became a development company instead of becoming an assisted living company. You know, if you open up 100 communities in a year, you can't possibly operate all those communities effectively, especially in assisted living where the people are frail and elderly and need help with activities, and you need more staff, especially in today's staffing environment. You would never want to open up that many communities in a year. So I don't see that in active adult, and hopefully we won't. And I think construction costs are going to limit some of that risk.
Well, availability, capital, not equity so much as debt. But I think to layer onto that, I think Greystar now, the operating company we built there, is now managing just around 100 communities. About half of those are owned assets, the others are third party. And they're doing a terrific job. I'm biased, of course, but learned a lot of lessons in the early days and put those lessons to work. And it is as we started the conversation, what really made that team sing was a best of both approach, where we took really good senior living people, combined them with really good multifamily people, and let all of them do what they do best in a team setting. But I think there is a benefit of scale, and Richard, I'm sure we'll touch on this, but what the multifamily companies do so well is scale. I mean, they have to, by definition, especially on the operational side. Systems, processes, efficiencies, all that stuff, they're very good at that. Well, what senior living companies are really good at is taking care of people, empathy, understanding, creating community, all the touchy-feely stuff, right, that great senior living operators have. And if you can figure out how to meld those two together, I do think you can scale effectively. But to Mark's point, I think there is it's still a people business. And we saw in the early days, if we get the community manager hired wrong, we get the wrong salesperson, the outcome isn't great. If you get the right team on the ground and you build the right product, it can be very good.
Yeah, actually, Ben, this time I'll actually answer your question. The 90s, which I lived through with the assisted living side, I think this is a little different from that, only because a lot of the problems within the 90s on developing the programming and the segmentation, that was so heavily service oriented that if you replicated that mistake, it could be exceptionally impactful. Whereas here, there is a larger play on the geography, the location, the building, and then less so on the people intensity portions of the service. So while we're trying to figure out what is that groove and what is the segmentation, at least we don't have to worry about, oh goodness, my entire service model is completely backwards and not going to go well. And that's a problem. So if you're going to make a mistake and you add 10 FTEs instead of 7, the ability to adjust fire in this space on active adult is far easier than if you really screwed up your service model in the early assisted living, formative days. And we lived through that in the 90s. I got to tell you, my margin, I literally still have my first pro forma on assisted living. In our first AL that we were building in the early 90s, I had at around 57% margin. I figured that seemed about right.
Not bad, Richard.
Yeah, not bad.
You're hired.
Yeah, I can tell you that never happened. Sometimes I thought I had the decimal in the wrong spot. So when you're going to make a mistake, mistakes made at scale on the service side can absolutely kill you. Now the locational differences aren't different. You still need to be located correctly and those type of things, but that's the difference I see. This feels a little less risky to make mistakes. Having said that, I appreciate Mitch and Graystar and a lot of these pioneers that have been out there doing it for a while. You guys gathering some of the data. We've been experimenting on a smaller scale ourselves, but I do feel there will be segmentation, and Mitch had mentioned it before about up market, down market, whether we're talking A product, B product. What is the thesis that you're building your active adult community for? What are you trying to fill as a void in the marketplace? And to Mitch's point, is as long as you're focused there's so many opportunities, and you get that right and you replicate it, man, sky's the limit.
I think it's almost more so than IL and AL. Active adult is kind of the Henry Ford concept of first figure out what kind of rent someone's going to pay in the market for your product, and then build your community around that and make sure you can get the lumber and concrete and labor to build it for that cost. You almost have to work backwards.
Yeah, that's a really important point. In the early days when there were no comps or very, very few, what were you comping to? And your point I wanted to go back to about 30% premium to multifamily is a very it's a dangerous data point, because like any kind of appraisal, which comps you pick, and we see in some of the coastal markets, multifamily rents are par with active adult rents because the real estate value is so high. Whereas in the normal middle of the country markets, you can achieve a 30 or even a 40% premium to the multifamily. But how old is that multifamily? Is it really a true comp? What really broke through in getting these right was the basics that Mark just hit on. What can our customers afford to pay? That rent income ratio, and to some degree the value of the home that they're selling to move out of, that we touched on earlier. Those things are really important. And then just one point back to Richard on yes, I understand the thing about mistaking the service model piece, but in some of the early adventures, we, especially in the upmarket segment, we thought, oh, they wanted all this stuff, continental breakfast, this, that. Boy, the challenge with this group of people, if you put it down in your marketing collateral or something that you're going to do these things, you better do them. And taking them away if they think that they were promised to them can be very, very challenging, as my colleagues at Graystar will tell you. So
I'm not sure that's any different than seniors housing, independent living. I get that all the time. Now.
So be very, very careful about, it's easier to layer on things than take things away. And that's where I think we haven't really talked about technology at all. Maybe we don't have time for it today, but having a great CRM, having all this technology tools that we try to build and are continuing to build. Multifamily, it's a great business, and they build it and they fill them up quickly, 25, 30 a month. We needed different tools for this, and we had to create a whole new toolkit, especially on the data side and the technology side. And so again, Nick is starting a new technology conference. I'm sure Richard's very involved in this, but having all that back end stuff, allowing your small 5, 6, 7 FTE staff to not have to sit around spending a whole day a week preparing reports for somebody upline, and instead spending that time with the customer, that's very much like senior living.
Mm-hmm.
And so having that back of house platform that I'm sure Richard's working on with his new venture is really critically important for successful active adult.
And I will tell you, just to touch on that, Mitch, you brought up a couple of really good points. The sales process, right? As most people know, Discovery is right into the sales systematic processing and everything. Very different, right? Very different. And then everyone needs to understand that both like multifamily, student, and a bunch of these things, a lot of the consumption of the leasing process is going to be done digitally going forward. And so you're talking about a very different theoretical construct of the sales process, where it's not as big relationship building, long buy cycle type stuff. This is very transactional for people. And you need to have the flexibility through technology to be able to execute on that desire to actually sign a lease and get rolling very, very quickly. And so from a training standpoint, we actually have totally different training curriculum, active adult versus seniors housing, and segmented further, as you might guess, on the various components of seniors housing that we're in. But this is a very unique sales process that we've defined in the active adult space because of all those things that Mitch had mentioned, plus the consumer's desire, the growing consumer's desire to complete a lot of these tasks digitally.
Well, there are definitely lessons to be learned from multifamily, lessons to be learned from seniors housing when people are considering their active adult developments or acquisitions. And I just want to poll our audience who they think is going to really kind of take over the industry in the next few years. Is it going to be the seniors housing guys, or is it going to be the multifamily guys?
You don't have Discovery up there, Ben. How come
We don't have a write-in option for Discovery, but I'm sure we'll get a lot of emails.
Oh, we can't vote? You locked us out. Come on, man.
Well, you guys at the end of the call are going to give your own opinion on this.
Okay.
So we will release the results of this poll at the end, and then I'll ask you guys right before we release and see if the audience is in agreement. But I do want to answer a couple of audience questions that just came in. So this is to anyone who wants it. Will active adult cannibalize or encroach on the market share of traditional independent living? And this is kind of related. Would you say that this product skims the cream from CCRCs?
I don't think it's going to cannibalize. I think it will on some level. I think that 78-year-old who probably doesn't need independent living will probably flip over to active adult at some point. But I think there's going to be a woodworking effect where people come out of the woodwork that say, hey, you now have a product that makes me want to sell my, $300,000 house or whatever it is, a $400,000 house, and pay for this in a smaller market. If it's Long Island, obviously they're selling their $2 million house and buying into a Greystar facility or whatever. But I think it's a product that's going to convince people to come out of the woodwork that are younger and more active. So I don't think it's going to, I think the more, just like the hotel industry, I don't think, I was one of those people that was concerned when I saw a Hilton Garden Inn building right next to a Hampton Inn building right next to it. And I thought, how are these all going to make it? And sure enough, they all succeeded because there's that concept in marketing and customer service where if you provide different tranches where they're nuanced, you're actually increasing the market in that one market area. And so people are flocking to that area to buy what you have.
Mm-hmm. Yeah. And Richard, we got another audience question. I'll direct this one to you. Early on, IL was for the resident who was more active. Now, in some cases, IL has become AL light. Over time, is active adult going to absorb the IL product? So we're left with the active adult resident without services and the resident that needs AL services. Can the IL product and community change their marketing to active adult in order to compete? Is that feasible?
Yes, I mean, look, at the end of the day, I think our thesis is pretty simple. And it really dovetails to your question prior to that. All of these segments are going to blur together and give you a continuum of options. And so depending on where you want to go, for example, that's a static question. That's kind of like a space and time question. But what you're going to see is as active adult continues to be more attractive to very active people in the independent living, which has evolved over time. I had made reference to that earlier. You're going to see a reaction on the independent living side. They're not just going to stand there and say, oh gosh, I guess we don't have any active people that we can go ahead and attract into our independent living anymore. Let's call ourselves assisted living light. No, in fact, you're already seeing it in the marketplace, right? This whole idea of a la carte, utilizing technology to be able to deliver services in a different way in independent living. We're seeing it because we're certainly employing a lot of those things, our flex choice plans, those type of things. You're going to continue to evolve the IL product to make sure you can continue to attract, some level of active person. There is a difference in the profile. It's not just monetary. Look, somebody that wants meals and those type of services, that doesn't necessitate it being someone who has a healthcare need, right? There are still people who desire to have that all-inclusive lifestyle. So I think, my favorite conjunction, right, is and so I do believe you have an and situation. You're going to be able to have independent living with folks who are active. And you're going to have active adult that doesn't have some of the components independent living has, who are also active. Mm-hmm. So I think it's an and proposition. Having said that, there's no denying that some of the independent living we have now, and have had for quite a while, to be quite frank, has a more, I don't know, AL light, I hate saying that, AL light feel to it. Mm-hmm. But I tend to believe that all of these will survive beside each other and none will cannibalize from the other completely. But in the margins, they will blur a little bit and it'll be about being able to differentiate. And the cool thing about the IL side that I think is differentiated enough from the active adult space right now is that food service component and some of those things that are clear, bright lines. Mm-hmm. Either the consumer who enjoys that and willing to pay a premium and a value to the owner operator for those services, or you're not. So I really like that kind of bright line that's there right now. Mm-hmm. Now, as you know, some active adult folks are trying to offer some catering type services inside their active adult community, both on the thesis that as people age in place, they could capture that revenue stream longer, but also as just another advanced amenity. And so it'll be interesting to see how that plays out. And should that bright line of services start kind of getting blurred, who knows where that goes.
Yeah, I like what Mitch and Richard said. We were talking as a group before we jumped on the webinar, and the active adult communities, the residents themselves sort of self-govern some of this, right? Like if they feel their community, which they take ownership in, on some level, they feel like there are residents in there that are just too high acuity, walkers, wheelchairs, and so forth. They'll self-govern the place. They'll let you know and make sure that it stays what it's supposed to be.
Yeah, it was Richard's comment. There was a big discussion during the NIC definitional phase, the white paper about, food is the bright line, as well put. I like to say in our world, in active adult, food is social currency. It's not, it's not a mandatory service. And it's interesting how much circulates around that definition around food. But, to the question about cannibalizing, in the upmarket segment, we've literally had in some locations, people who were actively shopping a CCRC either consider the active adult product if it was nice enough, or actually moved in and chose that in lieu of going into a CCRC. I think it is on the margin, as Richard said, but it's an interesting piece. I think the other interesting piece is, and I never expected to see, we're getting people who bought into a Dell Web, years ago, 8-10 years ago, and either, divorced, lost a spouse, something changed in their life. They didn't find that same, lifestyle as attractive as they did when they made the original decision, and like the intimacy and the scale of these active adult apartment communities, better. And it's a meaningful number. It's not a tiny number. So I thought that was another, when you talk about crossing over, a lot of say, well, we don't really compete with the Margaritaville. We don't compete with, all these new for sale versions coming out, which are great. I think they're interesting. So I think both can coexist, but we are definitely seeing some demand from those.
And just, I want to add one more point. So in my experience with active adult is more that upper market space, but on the independent living side, I want to amend my answer a little bit on just a little bit over in the more affordable markets, your secondary markets and things like that, where the definition of active adult is broadly defined as some of these senior apartments and things like. I think there is some ability to cannibalize in those spaces from the independent living, mostly because this, in our view, is more of an affordability question in the consumer's mind. And anytime you can provide a more affordable option for living as a senior, you're going to take some of that market share from those otherwise that would have been providing it. Yeah. But I think in the more primary markets that you have around there, less so. In those secondary markets, from affordability standpoint, I can see that.
I would agree with that. We saw that with Calamar. They take a good percentage of their initial, rental from the IL in the area, secondary markets, and I would imagine Clover's the same way. So if you're the only game in town and you're a 25, 30-year-old IL charging $3,800 a month, and along comes Clover or Calamar at $1,300, $1,400 a month, maybe sometimes less in some cases, that means a lot if you have a $350,000 net worth. So, and if you're only 71 years old and you may live to be 91, you have to think about those things. You don't want to out kick your coverage on your money.
Well, I want to talk about the separation of those two markets by moving on to our valuation stats. And unfortunately, due to time, we're going to have to kind of motor through a few of them a little bit more than I'd like. For our audience, we'll have more analysis of these statistics in a white paper that's going to be coming out after this webinar, based on the discussion, based on the statistics. Also, feel free to reach out if you want to just chat about some of the statistics we're seeing. But let's go to the next slide. Just quickly, this is average price and median price per unit for active adult communities over the last 4 years. As you can see in the top right, we've included kind of how high the prices per unit have gone. And that really shows that, the average is really that. It's an average of all the B quality communities, the A quality communities, and then even perhaps lower than B in some cases that have sold in those respective years, and understandably bringing the whole sector average down. But as we can see, based on the max prices here, it can go quite high. And just want to move on to the next slide. Talking about the average cap rate, there's a very narrow band as far as cap rates that we saw for active adult properties, much more similar to multifamily. We didn't have any cap rates above 6%, and we did not include any below 3.5% in our market average. And you can see that even with capital markets changing at the end of 2022, those changes in the capital markets may not be fully reflected in this average. Cap rates indeed may have gone up more. But this is also a combination of A and B properties. And so it's a factor of the share of those properties in these averages. And just want to move on to the next slide quickly, touch on it. This is the average NOI per unit for active adult communities. Again, it's A versus B. In the top right, you can see just how high NOI per units can go for communities. And I imagine you guys have some thoughts. It could go even higher, but the next slide breaks out the market between A and B communities. And we've defined A versus B based on a combination of the community's size, age, and location. That definition internally may change a little bit in the coming months as we just learn about this market and exactly what is an A quality community. So we've included the community profiles of these two subsectors here, just to show that average community age for A properties was 2013, 2014 in the 2 years that we looked at it. Some people may think that A's were really just built in the last 5 years. So take what you will with these averages. I just wanted to get your guys's comments on the average prices that you see here in the respective markets.
The only thing I would say as a deal maker side of things, yeah, I think the cap rates are within a pretty narrow band, maybe 25 basis points or so. But the NOIs are what shifts, right, based on the rates. So if you're at an average rate of $2,600 a month, your NOI is going to be around $17,000 a year, and your cap rate at a 5 cap is about $340 a unit. If you obviously cut that rate in half to around $1,400 a month, and your NOI to around $8,500 a month. If you do that math, it's pretty easy math. You're going to be at about $170 a unit. So for me, it's really about rates. Operating margins are still going to be around 55%. I think Mitch pointed out some of the Gray Star properties and Overtures and all that, they can be as high as 60, 62, after like a 3% management fee with some sort of incentive fee on top of that. But most of the margins are around 55. If you're going to use a generality, an average, those numbers are going to pan out to around those numbers I gave you.
And if we go to the next slide, we'll show the difference in cap rates and the difference in NOI per units for A versus B properties. Mitch, Richard, any comments on the two different markets?
Yeah, my 2 cents is I'm a math guy. Statistics, data matter. And right now there's just not enough to really create this. And so I guess a shout out to my multifamily brethren. They're very good at this. So I think as we are growing up and maturing in the active adult space, my plug would be, hopefully everybody will be much more revealing with their data, so that we can all make better decisions on this. But it's so market and segment dependent right now, and without enough data, I don't know that statistically I'm willing to lean into any of the numbers at this point.
Yeah, being able to segment the market data into smaller groups would definitely be more useful for an apples to apples comparison of their prices, profitability year over year.
Now, as far as cap rates, that's a wonderful discussion I'd love to have. But.
Yeah, and we track every transaction over the last 3, 4, 5 years, and there's absolutely enough data to show, and I totally agree with what Richard just said. He's absolutely right, but there is enough data to show that like for like, that, and I never thought I'd say this after 30 plus years in senior housing, that anything with an age qualification on it would be trading at, near, or even in some cases below like vintage conventional multifamily. That, and we talk about the whys. Yes, the residents, everybody, the sticky resident. We rode through COVID incredibly well, not without a lot of hard work by the operators. They did a lot of heavy lifting, but like everybody said, our residents cooking for themselves. They could hunker down. We didn't have the people coming in and out of the building. We managed that well, and we went through COVID and came out roaring out of it when the housing market took off. It's gonna be interesting to see where that goes next. Certainly some slowdown. The other thing we haven't touched on very much, and maybe you'll get into it, Ben, is the very marked difference in size, total number of unit count between the mid-market and the up-market, and the length to fill. The higher you go in the income and the psychographic band, the less the propensity to rent, hence much slower fill. Yet some of those really higher end properties, and the ones Richard's doing, once you get those full, much like senior living, they're incredibly great cash flowing assets, because those folks are less likely to move either for an economic reason or other reasons. Yes, they may move because they buy a house. We've seen that too in some of our more upmarket properties, where they wanted to be near their grandchildren, came into an area in the Sun Belt, didn't want to buy a house right away, wanted to get the lay of the land, and moved in with us for a couple of years and were great, had a great time, and then eventually they did buy a house. Some liked it so much they just stayed. So, but there are some additional nuances besides just the pure numbers here in how these different segments perform, and the lease up and the lease up risk and the duration of your capital investment and return is very different on the upmarket than it is on some of the mid-market projects that like the ones Mark was just involved in.
Well, and haven't we found after 2008 and 2009 that housing crash and some of their volatility in the housing markets that there's been a resurgence of the renter by, or an increase in renter by choice too, right? That's probably
Yeah,
a big part of what we're
definitely.
seeing.
Yeah, and the stigma of that's an interesting comment. We did these focus groups and we're sitting around with a group of residents who've been in situ for, 6 months, a year and a half. And they're saying, yeah, they don't think of themselves as renters. This is my home.
Yeah.
I own, they're in almost every respect, they act like they own the place.
It's just like Richard said, it's just math. Like if I pay $2,600 a month, which is less than my mortgage payment, on my house in West Palm or whatever, and I can still travel or maybe even still have the house, who knows, depending on how wealthy they are. And for them, it's just math. And if the house I custom built doesn't sell for much more than I built it for, I can't write in a big increase in my home value anyway. And I've got to pay the taxes on it. And once I figure out the real estate taxes and the insurance and everything, especially hurricane insurance in Florida and all that stuff, maybe that 2,800 doesn't look that bad math wise either.
That's right.
I just want to move on to the M&A market now. And, we touched on these valuation statistics, but the M&A market, just as a share of investment dollars flooding into the space, I think most would agree that it's less than what we've seen on the development side. Just such a new market, and a lot of these communities first have to be built, fill up, and then sell. And so, we should see more sales comps in the coming years. But Richard, based on what's happened in the capital markets in the last 6 months, last month, what do you think is going to happen to investor interest on the M&A front in a rising interest rate environment, or amid all of this mayhem going on amid the banks with potential liquidity problems?
Yeah, I mean, it's a scary answer if you just take it in a point of time of today. I mean, a lot of folks are going to be looking, if you're an investor and you're having to make a decision on where to put your capital solely, I think on the M&A side, I think a lot of these trades will be sidelined for a little while. And that's outside of the debt markets, which everybody relax. That'll figure itself out. It's going to be okay. But longer term, I think you're going to find that there's going to be a segment of folks, even in today's market, where you can go and get on a price per pound basis a much more attractive acquisition opportunity of an existing seniors housing asset that might be under distress, where you can put some type of CapEx thesis value add play in there and create returns that are really high. But you're going to have strategic buyers, I believe, that play through even during this time and see the future and see that ability to compress the cap rates over time as we mature, very much the thesis that my colleagues here are talking about. So I do believe you're going to continue to see some M&A activity, and I absolutely know you're going to see some new development activity because I'm not stopping. And so I'm guessing I'm not alone there, right? Because it's about the longer term, not just what's happening today. But without a doubt, I think you're going to see a little bit of shift on the buyer side in the short term, generally toward the acquisition of existing stuff that are a little more trouble, a little more value add.
Mm-hmm.
And I think a lot of
go on.
I was gonna say a lot of the M&A activity stems from just a strategic, again, math decision to build for X dollars a unit, build to a certain cap rate, sell for a compressed cap rate, or take that developer's profit, continue to build a platform of the operating company and own some. We see this across the senior housing continuum. We own these, we manage these, but we don't own them. You see a lot of that, a lot more of that than you did in the 90s. So I think that's a good tranching of the business, if that's a word as well, is now that I'm an investor and a builder, I don't have to own all 80 that I build. I could build 20 and sell them and then own another 20, decide when to sell those, either at C of O or stabilization. So I think you're going to see a lot of that too. It's just it's a decision on capital structure.
Mm-hmm. And Mark, I have another question for you, a little more on just the lending front. But before that, I want to launch our second poll, which is asking the question: would you rather build or buy right now? And before we move on to the kind of building segment of the conversation, Mark, I just want to ask you: do the same group of lenders that work within seniors housing also lend for active adult? And there's an audience question: is there any refinancing, any temporary hard money loan to permanent financing involved in investing in active adult construction?
So the first question, the same lenders that lend on multifamily by and large lend on active adult.
Mhm.
Our finance group is saying that even Fannie and Freddie will, it may go under the senior housing banner, but the underwriting criteria are the same as multifamily. Fannie and Freddie use, the same kind of structure for underwriting as they do for multi.
Mhm.
As far as bridge or hard money, I'm not trying to be funny, but people will lend you money for anything if you pay enough. So I would imagine there's hard money out there. There's bridge money to Fannie or Freddie, or bridge to construction loan to mini perm to some GSE execution. As long as you're willing to pay for it, it's all about risk and return to the investor, to the lender. But I would say that the financing sources are broad, much broader than they would be for, say, skilled nursing or some higher acuity product type, where there are very specialized lenders who are looking to the sponsor. And the sponsor is going to be important here too, but the real estate, the location, and the feel of it being more like multifamily is going to broaden the lending opportunities.
Yeah, just to lay onto that, when a loan request came out of Greystar, it automatically went to the side of the house that was multifamily. So but there were multiple hours long conversations about what is this, how does it work, what's different. I think we're seeing more senior living lenders and equity providers coming in and looking. And frankly, to me, what's not happened in
Mitch,
senior living.
do you want to repeat yourself? We lost you for a few seconds.
Sorry, I cut out. All I was saying was that both people who have expertise, both multifamily and senior living within the same entity, should get together and help educate each other, because that doesn't happen naturally. If that makes sense.
Yeah.
Well, they'll come together after this call, I'm sure.
Good, I hope so.
Yeah, and just wanted.
Doesn't it feel familiar? Right? I mean,
Kind of, yeah.
all the things we're talking about, it feels like when seniors housing was just forming. All of these things where we said, no one even knew what independent living was. So it feels very familiar.
Deja vu all over again. Yeah.
I think our industry is a little more humble now, though, than back then. I think people, hopefully that's the case. I think people thought they knew what seniors wanted and they just built it. I remember I'm dating myself totally now, but late 80s, early 90s, you had some companies, I won't name them, that, these big multifamily companies, they're building, 1,200 square foot units with huge Olympic sized swimming pools. Like they were building for student housing or something. You're like, these people are like 82 years old, 84. They don't want all that stuff. So.
Yeah, I'm only smiling because my largest one I built during those times was 1,700 and something square feet.
Yeah.
Thanks, Mark. Appreciate that.
Yeah, but no, I mean, we learned, right? I think we're humble now, and more humble, and we know that we gotta kind of ask the customer, what do you want?
Right.
Yeah.
That's a good segue to the future.
Yeah.
And new development right now, dude.
Oh yeah. Well, I've got one question on new development for Mitch and Richard. Just quickly, are you seeing the cost to build higher or lower than the cost to buy a fully leased community or a partially leased community?
Higher.
Yeah.
In both. I mean, both. It depends on circumstances, but generally, yeah.
Higher to build, or
mostly higher to build right now.
Yeah, it's higher to build.
Well, we're in that transition phase, right? Where you have every inflationary environment, it's like we get amnesia every time inflation hits. And in every environment like this, there's a transition phase because it doesn't move exactly according to the other. So we have the setting in and understanding of what's happening with the tempo of development, getting, seeping into the overall costs. And that's from a labor standpoint, a material standpoint. It's going to take time for that to come down as that reality is now sinking in. But then exacerbating that is your cost of financing and everything, takes this amazing trajectory up in such a short period of time. Normally the transition cycle is a little bit more smooth, where one is offsetting some or all of the other. And so at the end of the day, Mitch and Mark certainly has seen this. We had plenty of development activity going on when there's 7-8% interest rate over the course of decades. Not a problem, but we're in this weird transitory time where the costs are still high, they will come down, and the carry is really high.
Having said all that, I think, again, getting back to the math, if there is a property or group of properties out there with assumable GSE debt or long-term debt of 5 to 7 years, at say 4.25, 4.25 didn't look that great a year and a half ago, 4.25 assumable with a 62% LTV, to me, that has a little bit of a premium to it, feel to it, because if you're going to go out and finance something new, you're going to be at, like you said, Richard, 6-7%. So I would argue, that the debt constant might be a little high in some cases, but your IRR will be fine, but your cash on cash might be a little low. So if you have an institutional buyer that can put down, more on the front end, and some of them don't even like leverage above, 40, 50, 60%. So this is the time when they have first mover advantage, I think, on some of this assumable debt.
The important takeaway, Ben, is that deals are still getting done, but they're getting done with a lot of scrutiny and a lot of careful analysis and pretty substantial contingencies. But there are still deals getting done.
Yep.
And with more cash going in.
Yeah. And the scrutiny and more cash is right. That makes sense for the market that we're in right now. And well, now we can move on to the future of active adult. And I think if you guys are okay, we'll stay on for an extra 5 minutes just to cover some of the last questions. And any audience questions that we have not addressed, we'll be following up over email afterwards. So don't worry, we will get to them. But Mitch, I just wanted to ask you: is the rise of active adult good or bad for the rest of the seniors housing continuum?
I feel it's good, and I think it's been coming for years. I think Richard touched on all these things, as did Mark. For years at Kisco, we were always debating, is independent living viable over the long term, because of what we saw happening with the changes in the customer and demographics. And to your earlier question, there's still a place for, I think, independent living, depending on what you call that or what it looks like. Certainly the CCRC model is as healthy as it's ever been. Mm-hmm. So I think overall it's good, because I think the mantra of the boomers, and I am one, is I'm good, I'm out of here. None of us want to go this long slide. Richard touched on this earlier. It's a different perspective, and I think he described it really well. Mm-hmm. Our goal is, eat well, live well, experience life at its fullest at this stage of our lives. And then when we need AL and memory care, it'll be there for us. But mm-hmm. I think that's the opportunity for active adult.
Got it. And I want to get the results of our seniors housing versus multifamily poll.
Wow.
Well, that's helpful.
That's really interesting.
That's a bad time, as it should be.
That might be an accurate. That might be an accurate answer.
The answer is both.
Right.
I don't want to hear both as an answer.
Yeah.
All right. Well, we're rapid fire. Let's go down the line. And who you think is going to take over? Mark, seniors housing or multifamily?
I don't know. Probably lean a little bit more toward multifamily for this particular product type. But I wanted to answer the future of active adult. I think it does have its place, but I would echo what Mitch said about IL. Still very viable. And again, if you do the math, if we can get back to those 35-40% margins, fix this whole problem with agency and labor and so forth, there's definitely a need for that 85-year-old to have 2-3 meals a day and a little bit more camaraderie and housekeeping and so forth. So the IL is not going to die. It's just fine. This is a both and, as Richard's been saying. We're adding this as a tranche to the hotel flags, if you will. We're not taking away the limited service hotel or the full service Ritz. This is just an additional product. Yeah.
All right, Mitch and Richard, seniors housing or multifamily?
I like the chart.
Yeah.
I like the chart.
You're going with our audience. Oh.
Yeah. No, I really do. And here's why, because Mitch said it right at the beginning. He said, we took the best and smartest minds of multifamily, added the best and smartest minds in seniors housing, and put them together to come up with the best and smartest solution. Well, that's going to happen on both sides here. You're going to have multifamily who's smart enough to go out and get a bunch of really smart seniors housing folks who are used to caring and thinking through the process of senior living And then the opposite, the seniors housing folks, like what we're doing, we lean into the multifamily side and really understand what that does well. And oh, by the way, I would add student housing to that. Student housing developers have something to say in here. So that's going to happen as well, in my opinion.
Hospitality, potentially.
Are we going to see 4 and 5 seniors in the same apartment sharing a kitchen?
With
Bunks.
really loud music.
Co-living,
What's the top
Down by the bed?
co-living is happening right now, Mark. And
Okay.
I think co-living for seniors could be a part of the future.
All right.
then-
You're the guy, Mitch.
And let's get the last poll up, the build versus buy question, and then rapid fire, go down the line.
Another tie. Wow.
I
This
say
is
bye.
all right. Mark says buy. Mitch, what about you?
I'm a developer, dude. I gotta build.
Richard, you do both.
I do both, but right now we're launching our choreographed brand and we're going to lean into that heavy. We will figure out how to build it. If you ask me if I'm going to build them all in June, the answer is no. But over the course of the next year, yeah, certainly leaning toward it.
Awesome. All right. Well, I mean, I've never seen poll
That's
results
crazy.
like that on a call of ours. So I think
Same
there's a lot to
question.
take out of that. Maybe we'll do some psychographic, segmentation of our audience and see, how many seniors people, how many multifamily people, and who else was
Apparently it's
on the
50-50.
call. But apparently it was 50-50. All right, you guys. Well, I think that there are enough questions that we did not get to today that this could potentially warrant a 2.0 conversation. If you're willing, let's
That'd be great.
let's see how many emails we get from people that they're crying out for more. I think they are. I mean, there's still many questions to answer on the operating side. How you can really operate these kind of communities on the top end of the market and for the middle market, how you can operate them really well, any pitfalls to avoid, and then kind of more details on exactly what the M&A process is like, what the development process is like, market studies for these types of communities. We could go on for hours, but unfortunately we're at our time today. And I want to thank you all for joining the panel, all the prep that went into this, all the back and forth on the statistics, had a great conversation leading up to this, and then I think the webinar went off without a hitch. And just want to thank you again, appreciate it, and well, maybe everyone will see this panel again soon.
Good job, Ben.
Be great. Thanks for having us,
Nice
Ben.
job.
Appreciate it. Mitch and Richard, good to be with you.
Likewise.
Thanks so much,
Thanks.
everyone. All right,
Thank you.
webinar is now concluded.